Coming up, a closer look at China's economic stimulus measures. Will they work? Next. It is your daily 10-minute business and finance news wrap for this Thursday, the 26th of September 2024. The Australian share market had a good day today, up 1%. That's on optimism China is preparing to add to its large suite of economic stimulus measures announced earlier this week, but will it work? For more, I spoke with Chris Weston, Head of Research at Pepperstone.
Yeah, so I think, Ricardo, we've seen a number of policy measures coming through, cuts to the bank's reserve ratio requirements. We've seen the actual benchmark policy rate being cut by 20 basis points. They've reduced the down payments for people's on second homes from 20% down to 15%. Housing buyback re-lending, and then you've actually had some measures directly to pump up the equity market. Banks and brokers and insurance and pension companies essentially can get very cheap liquidity to buy Chinese mainland equity companies. There's a whole number of raft of measures that have come through, and I suppose I don't think anyone's really too surprised by what we've heard, and the timing is certainly not a surprise ahead of the Golden Week holiday and the 75th anniversary of the People's Republic. I think the raft of measures, the extent of the measures has certainly surprised quite a few people. And today we've also heard that the PBOC are going to look to inject over $100 billion into the banking system, which makes some sense. If you're going to lower the cost of capital, obviously there's going to be a big impact on banks' net interest margins if volumes are not going to be taken up because people and households essentially are looking to save and looking to pay back debt. The demand's just not there. But look, I think a lot of the measures we've seen there are really directly to try and window dress and try and pump up the equity market ahead of the Golden Week holiday. I think a lot of these measures to bring down the cost of capital, they're not really going to do a huge amount because at the end of the day, you need to stoke up demand. You need people to actually want to take out credit to get investments, and that's just not there at the moment. There's a negative expectancy on property prices, and as I say, I think most households and business just want to pay down debt and save. So a lot of measures coming through. The timing's not a huge surprise, but I think the raft of measures or the extent of the measures has probably knocked a few people back a bit, and it's been a fairly powerful statement there.
Given that it's still a big package over the past week or so, right? What kind of a message do you think China is trying to send?
Well, I think first of all, they're trying to incentivize people to buy Chinese equities. We got down to very low levels in the mainland equity markets, lowest levels for a couple of years, and I think they really just wanted to send a message: go and buy stock, because it's obviously having a market in free fall is not a great look, especially going into obviously the keynote anniversary. But I think there's also another message out there that there is obviously genuine concern about the level of demand and consumption that's taking place in China. Retail sales have a direct correlation into the GDP calculation. And there's obviously a lot of concern at the moment about demand in China. We've seen a raft of economists downgrading their GDP forecast below 5%, which is their target at the moment. Obviously, we've recently seen some big moves down in commodity prices, copper, iron ore, and various factors. We've had a little bit of a rebound. But I think generally speaking, people have been quite concerned about the level of consumption and lack of animal spirits that's taking place in China. So will these measures, really promote a reflationary cycle and get people spending? I don't think anyone expects that, but I think more is definitely in store for China. But it's got to the stage now where, after a lot of anticipation that we were going to see in monetary easing and fiscal spending, we are starting to see much more tangible evidence that we can sink our teeth into here.
What kind of stimulus do you think investors are wanting to see from China then?
Yeah, I mean, I think, all said and done, people's perception of asset prices in China needs to change. If you've got a negative expectancy of property, you're not going to go and buy a house, even if the cost of capital is cheap. If people are not feeling great about their personal situation, they're not going to spend money. And so to change the perception of that, these measures, whilst obviously warranted and helpful, are not going to change that dynamic. And, I think we're going to need to see much more, quantitative easing to the tune of, we're talking trillions of dollars, real fiscal spending to make people feel wealthier, create jobs, and get that demand going on. Because at the moment, reducing the cost of capital, here and there, when it's all already very, very cheap, it's just not going to drive that situation. So consumption needs to change. Needs to change, and people's perception of the investments that are cheap to borrow for need to change. And I don't think they've done that yet, but I think a big package further down the line will come, and it may need to see the equity market down another sort of 5-10% for that to happen, and that might not happen anytime soon. But I think weaker stock markets and weaker asset prices, and obviously deterioration in economics, especially around the sort of the retail numbers, I think then you're going to see markets starting to believe that we're going to see a very punchy package playing through on the fiscal level. But it has to get people thinking about spending money, get that animal spirits going. At the moment, that's not coming, and that's obviously not clear.
You mentioned markets there. Is it fair to say that this raft of stimulus packages from China then is behind some of the bullishness or the upside we've seen in the Australian share market at the moment, including the dollar? Of course, in addition to the interest rate differential with the US starting to cut rates, because we've seen that iron ore price come up as well.
Yeah, exactly. I think the Aussie dollar has had a nice run recently. I've sort of lost a bit of the impetus, but I think China's a huge part of that. I mean, obviously you've got to take into consideration the fact that recently the US dollar has been weak as well, and the Fed came out and cut 50 basis points, and a lot of the Fed members have suggested that it wasn't to do with the labour market. It was actually because they're worried about undershooting on the inflation side, which is a really interesting and emerging dynamic that's playing through. But I think if you've got a Chinese equity market that's rallied nearly 10% from its recent lows, industrial metals finding better buyers, copper looking a bit better, the Australian dollar is always going to take in tailwinds from that. So we talk about interest rate differentials, the fact that the RBA are really in no rush to be cutting. It looks like that's probably a 2025 story at the moment. And of course, the Fed are looking to cut more aggressively. But there's times like this when China's in a better spot and you're seeing a stronger equity market, that the Australian dollar will revert back to being a proxy of the Chinese markets effectively. So stronger Chinese markets, a stronger yuan, and the Australian dollar is going to take in tailwinds from that, which is what we've been seeing.
Chris Weston there from Pepperstone. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.